Good morning, folks. Happy Wednesday. Another joyful day. Looking forward to going through a series of issues that we are currently presenting as we speak right now, dealing with the Biden administration's efforts to change the tax law. Today's discussion will not be a political face the nation topic of whether or not this is a proper or correct thing to do. We've all worked too many years and paid income tax and then saved our money and invested it adroitly and paid gains tax, and then the privilege of having those assets now be taxed on our death. Is that fair? We have the whole other side, which is the outstripping of the ultra affluent and ameliorating, if not evaporating, the middle class. And what can we do to see some equalization through social programs, through infrastructure, through international presence, and so forth, where what is correct. What we do know is that these opportunities have existed for many years, and we want you to know that there is a significant risk that these opportunities will evaporate. We cannot guarantee you which ones will, but there are two critical pieces. Part one is that there is an effort to reduce the estate tax exemption from 11.7 million to 5 million and change. The second piece is that strategies which have been used for years to effectively transfer the assets to help with the compounding of the value of these assets inside the trust, what we call tax alpha, are also in jeopardy. Passing a bill to reduce the estate tax exemption is one thing. Having executive orders where President Biden and his staff can work directly with the Department of Revenue to eliminate certain strategies, something that the Obama administration did only at the final last piece of their period of time, is now something that can be done without legislative approval. It is our view that these strategies are as much in jeopardy as the tax exemption, and it is the purpose of this discussion. Many of you who are on this presentation and have been on the iterations of presentations before this have a significant amount of planning in place right now. You may have already created some of the strategies, each of these. We know you've created many of them, but each and every one of these. And we'll talk about GRATs, we'll talk about grantor trust, and we will talk about partnerships and the use of discounts. It is our view that if you have created certain trusts and they have been outside of the audit period, meaning they've passed the 3-year period for the IRS to challenge, then we need to leave those old and cold up on the shelf. They have done their job. They are sacred. If you fund those same trusts, your exposure is that not only does the IRS look at the gift you're making, because that's the first challenge, but looks at the structure as a whole and questions the structure as it is. If the structure is put into jeopardy, the original one that was created, it could reverse out the entire gift. We work hard to make sure that your structures are in place, but it is prudent behavior to make sure that we don't claw back an opportunity to review prior gifts because of you funding an existing trust. We are recommending starting with fresh structures, number one. Number two is that the period of time after the audit ends, opportunity ends, will combine these trusts because we have built them in such a way that allow for the blending of them. And we have done a lot of work where firms have not put the opportunity to blend trusts of remarkably similar facts. And as a result, it is complicated. But your trust that we have created for you now and these new ones, which also represent the newest iteration, we will take the old trust and blend them together because of their provisions. Number three is President Trump was clever in a way to reduce estate tax by reducing those who would impose the estate tax, and that's those in the examination divisions of the IRS. President Biden is doing the opposite. He is funding the IRS, the service, by bringing more people in, which means that there will be more scrutiny by more agents and more opportunities for audits. All the more reason that you want to have your structures in place and buttoned up. And you also need to be mindful to move quickly because of the opportunity that the Biden administration can move with executive orders on certain of these structures. Some of you who watch this closely remember that President Obama sought to remove discounts on family partnerships when there were intra-family gifts. He got that approved in the last month of his term. Immediately thereafter, when he left office, President Trump reversed that out. To believe that this is a matter of just moving assets, taking advantage of when the next Republican president comes into office is a fool's errand. Number one is that we've watched even the tax issues where under the Trump bills you can no longer deduct your state income tax against your federal, right? And we thought that this was a disaster, and it was an attack by the Republicans against those high tax states like New York, New Jersey, California, and so forth. We now know that there is no expectation by the Democrats to reverse that out. So the point being that the early Biden's bills and Biden's current plan through potential executive orders to take away the effectiveness of grantor trust, take away the effectiveness of grants, take away the effectiveness of partnerships at this very early stage in his term gives people a significant amount of time to adjust to this and expect that this is no longer available. And then as people get more comfortable, it may be at the end of his first term or in a second term, they could ratify this by incorporating an executive order into the legislative process. So grantor trust will no longer be effective at that point, or will continue not to. We'll talk about three things today, the three that we believe are in jeopardy. Grantor trusts, which are those trusts that compound without taxation to the grantor, to the trust. The grantor pays the tax, a beautiful way for a trust that has 5, 10, 20, 50 million in it, the annual income from that, rather than the trust suffering the tax drag, the tax is picked up by the grantor or the grantor's spouse. Yes, the trust can make distributions to pay that tax if the tax is too high, but what a beautiful, glorious way to supercharge the trust with the compounding inside of it. The second is grats, and Ben will speak about those issues as well. Grats are a great way to loan assets effectively to your loved ones and have them only pay you back the original principal and a small coupon of interest. And the result being that whatever growth took place will pass to your loved ones free of tax. You just have to outlive the term. And Ben will address that issue. And the last one is partnerships. And the most effective way to squeeze the air out of the balloon, as I will use frequently, get it flattened out or as close to as possible, gently slide it under the door frame, which is the tax threshold, and then poof, let it grow on the other side of the tax threshold. Partnership discounting, we believe, is a justifiable business strategy, because if I own 100% of my business and I transfer 49% of it to someone else, the discounting is in place because the receiver cannot make decisions in our partnership, such as dissolving it, removing me, requiring distributions, even selling it to third parties. And so discounting has been in our history for over 100 years. Even when you look at partners dividing assets, whether it's maritally or two business partners, the one that lacks controlling interest will always have a value that's a discount. When it's now an intra-family discussion, we now see that the government is trying to eliminate that as well. So with that, let us move on. Ben, who heads our wealth transfer practice group, has been with us for coming up soon enough 20 years, and is regarded in that position of wealth transfer, and also heading our private client practice area, an exclusive area where he's meeting with clients 2, 3, 4 times a year on a variety of topics, from family succession to the family mission, to philanthropy, to just organize annual compliance for the structures put in place. There is no one more suited, and is always viewed as one of the brightest and most informed in the community, and certainly at our office. So with that, Ben, take the lead here and discuss where we are. Thank you so much, Ben, for joining me and us.
Appreciate the kind sentiments and the introduction, John. And good morning, everybody. For those of you who joined us earlier this summer in June, we were focused on the 99.8% Act that Senator Sanders proposed back in March. And as John suggested, and what we're going to find today, even though we have a more recent development, a lot of the themes remain the same. And the recent development, of course, is the Build Back Better Act. It was proposed by the House in mid-September. Where things stand right now, it was supposed to come to the floor last week for a vote, but Speaker Pelosi did not do so because, of course, there has not been an agreement on the moderate side of her caucus in the House of Representatives, and there are in particular 2 holdouts in the Senate who disagree with the spending and tax plan as a whole. Now Congress is focused on, as you probably know, the debt ceiling concerns for this week and likely for the next couple of weeks. So there is a bit of uncertainty as to when they'll pick this discussion up, but there are active negotiations certainly about the proposed budget for the next several years that Democrats will want to enact. So right now, we just want to give a top line indication of the things that we do know are in the proposal, so that can give us a window into the current line of thinking. And we'll of course touch upon a little later how we're speaking to all of you about what you might consider and be prepared to do before any new legislation is passed. And so the top line issue, of course, has always been the estate tax exemption and the gift exemption. For the past few years, since the beginning of 2018, that limit was 11.7 and continues to be $11.7 million. That's nearly $23.5 million for a married couple. What the House is proposing is basically to cut that exemption in half. And that is something we knew all along was coming in 2025. And the proposal out there is just to accelerate the reduction in the exemption so that it will happen sooner. The tax rate for states above the proposed limit would remain at 40%, which is a bit of relatively positive news, given that the Sanders bill earlier in the year was calling for a much more dramatic escalation of tax rates, especially for those families above $10 million. And of course, what is important about this piece of the puzzle is that the effective date of the tax law change will be January 1st, 2022. So there is some comfort that even if this passes, gifts to this extent can be made through the end of the year. That said, John mentioned that there are efforts here not only to limit how much you can transfer during lifetime, but to take away a lot of the traditionally popular tools for how all of you have really gone about that for the past couple of decades. And so we'll focus a bit on what is in this proposed legislation that could really change the paradigm, how high net worth families efficiently and flexibly transfer wealth. So the three issues that John talked about, grantor trusts, grantor retained annuity trusts, and discounting for closely held business interests are what we'll focus on. And the general theme here, as you're probably concluding, is number one, we want, the government may want to make it a lot more difficult and in many instances to discourage and disincentivize families from making significant wealth transfers during lifetime. And that is all, part of the efforts that we've seen over the past year or so. And number two is that there is a bit more sophistication in how this is being approached from a legislative perspective. This is the most clear evidence, the House proposal, that there's going to be a real effort to take away some sophisticated wealth transfer techniques, again, that really have been relied upon consistently for a good period of time. So to speak first to grantor trusts, this is the most common type of irrevocable trust that gifts are being made to. And the reason why it's so popular is because this type of trust allows a great deal of access and control to remain with the gift maker. That's typically done by, for married couples, having a spouse be the trustee and beneficiary. So distributions can be readily available if there's a need to draw upon assets. The donor of the gift has the ability to borrow in a very simple way from the trust if there's a need to access assets in that way. The donor can reacquire assets that are in the trust by swapping in and out other assets that he or she personally holds that may be of equal value. So for all of these reasons, grantor trusts are a real effective tool to not only transfer significant wealth and take advantage of the gift exemptions that are available, but to do so with some degree of confidence that you have the opportunity to draw upon it in a time of need. And as John suggested, another real benefit here is that if the grantor, the person who's making the gift, has retained these powers and therefore, according to the IRS, has the responsibility of paying the income tax, it allows for the assets inside the trust to compound in value without any income tax. So there's no drag, there's no headwinds. It allows the assets that are in the trust to appreciate as much as possible. And in the meantime, if the creator of the trust is the one who's picking up the income tax, it is stemming or freezing, in some respects, the growth of the grantor's estate. And that's exactly what we seek to achieve. We want to make sure that we're not increasing the estate tax problem that will certainly impact the vast majority of you as time goes along. Now, what is actually in the proposed budget is that after the effective date of the legislation, meaning once President Biden signs it, whether it's this year or next year, any new grantor trusts or any contributions, even to existing grantor trusts after it becomes law, would be included back in the estate. Okay, so it really undermines the whole purpose of why you've undertaken these approaches, which is to remove growing assets from the taxable estate. And the effort here is to say, okay, if you want to make significant gifts, we're going to make it a little painful. You can't do it to a trust where your spouse is the trustee or can receive distributions without the participation of multiple parties. You can't freely borrow from the trust or do the swapping of different assets into and out of the trust. And likewise, certainly the implication on the growth side is they want to make sure that there is limited opportunity to have the assets that have been gifted to grow and compound free of income tax. So it really would have a significant detriment to what you've benefited from for the past number of years in terms of sheltering wealth across multiple generations. And the last thing I'll add, I know John will want to jump in a bit more on this, but this will effectively eliminate another tool called installment sales. It's similar to a GRAT strategy, but an installment sale is where you are selling to a trust interest in a closely held business or other type of investment, and the trust does not pay you money back immediately, but over time. So there's a promissory note between you and the trust, and then the trust over a term of years will pay you back. And what it does is it allows you to preserve a revenue stream because the trust is paying that debt off to you over a period of time. But the actual asset that's been moved into the trust, where the real value is growing, again, free of income tax and is outside of the estate. So that strategy will be completely eliminated, or not necessarily eliminated, but you will be disincentivized from undertaking it, because if you were to do it, the IRS is then going to say you're paying a capital gains tax because it's a sale.
Well done. Thank you, Ben. So I think there are a couple of pieces that we want to highlight here for sure. One is, what does compounding look like? And we've always heard this from people like Warren Buffett, the power of compounding. Those of you, many on this call, are professional investors and invest for others. We know the power of tax deferral and the power of compounding as it is, that these assets are growing inside the trust without the tax drag. Even what happened when we were in 2012, we were up 30%, there was no tax drag, and that is how we could double the net worth of these trusts, which would otherwise have not grown in that way. The other pieces are swapping assets in and out of the trust without taxation, as Ben often refers to in our private client group meetings. The importance of watching these closely and seeing the performance. I use the example of walking through Grand Central, and there are 6 or 7 escalators going up to the main level, to the street level. And I'll often watch to see which one is moving quicker and which one has more runway for me to run up. always hustling. And that's what we want to do with the assets inside the trust. We want to see these assets compounding and swap the ones that are moving faster and take out the ones that are not, because all of that is inside the trust, is avoiding estate tax on your passing, and is more asset protected, and the private client group, Ben, gets to do that. That said, the other piece is that for years, when folks said, look, I can only get 5 million into the trust, now it's 11.7 million, and then we would say, well, you can discount your business assets, and we can scrunch in maybe 15 million or 16 million when we take a 30% discount. Every discount is different depending on the type of business and the restrictions they have, and the partnership we put it in. But then they say, what's left? And so one of the genius opportunities that exist in estate planning among the sophisticated practitioners is to now buy more assets inside the trust. So there is a 10% funding requirement, but it has allowed us to have clients that have 50, 100, $150 million of assets that we can discount down by 25 to 45 or more percent, and then get 150 million down to 100. And with $10 million of assets in the partnership inside the grantor trust, we can then proceed to have the trust buy these other assets at a discount and have a simple note paid back with today's low interest rates. And all this growth, first of all, is at the full growth is taking place off of the full value, not the discounted value, number one. And number two is that the amount paid back is just the original purchase plus a little bit of interest. So it's not unreasonable to see outsized returns. President Obama's strategy was these things only really work for the ultra affluent. That is true. They only work for the ultra affluent, but the world is filled with people who have, for many reasons, and some of them are hard work and adroit investing, have achieved that. And with that, sometimes they can part the seas on opportunities, and that this is only available for the ultra affluent is in some respects precisely what President Biden is seeking to do. And many of President Biden's staff are very focused, and they were the same staff members who were very focused on social change, very focused on the redistribution of wealth at certain levels, and they are more committed than ever, and frankly may have a better audience and more potentially more malleable with the current president. And we know this because they're our clients' children who are in Washington. So this trust, we are concerned, not only needs to be created in this year, but also needs to be funded in this year, and transactions need to be done this year. Now, what happens if this doesn't happen? And frankly, Ben, we ask this question with greater repetition than any one of you is asking us, because we know that could be, and we've watched. But what you've done is you've moved assets into a protected vehicle that were purchased at a discount, or that were transferred at a discount, that are compounding without tax inside of it. So they remain asset protected, and you're getting more assets free of tax along the generational lines. That is the upside that we've experienced before, and we experience now. The difference here is when you're hosting a party, you clean house. If it turns out that the party is not happening, you still have a clean house. But in the end here, you'll have greater value for the work that you're doing. This is not an easy period for we as practitioners, because as we cross our 30th anniversary and have 20 people eat, sleeping, and drinking what's going on in Washington and the strategies, we are working harder than ever. That said, our calling and our responsibility to you all is to impress the importance of this potential urgency. So with that, Ben, I'll stop.
Thanks, John. Just one thing that I'd add, we've been talking about big gifts, transfers of significant assets, but this is going to impact how you fund annual exclusion gifts to separate trusts for your children. This will impact how you pay insurance premiums from your irrevocable life insurance trust. And certainly ever since this was on our radar when Senator Sanders proposed it at the beginning of the year, we've been talking about different ways that we can either adapt the trust through decanting, reclassifying the trust as non-grantor trusts, perhaps pre-funding all future insurance premiums in trust by gift or by loans. But the main thing we're trying to impart here is we have to be prepared to act if this ultimately comes about, because it will change the way many of the things that you've done, even at a more fundamental level, have occurred historically. And so with that, I'll take a look at grantor retained annuity trusts, or GRATs. This has long been a very popular technique when you have completely exhausted your lifetime gift exemption, and many of you have completed these strategies successfully in the past. So you're well familiar with it. The general idea is this type of trust allows you to effectively get growing assets out of the estate, convey them to your children or grandchildren or other loved ones, and you're not using up any of your lifetime gift exemption. And the way that it works is you create the trust, you receive annuity payments back based on the amount that you originally contributed, and the annuity payments take place over a period of years, 3 years, 5 years, 9 years. There's a little bit of interest that is factored into those annuity payments that you get back every year. But the idea is that if the trust is performing well beyond that interest rate, there will be a really meaningful amount of assets that remain in the trust once the annuity period ends. And again, all of that growth in value then passes to your family without having to use any of your lifetime exemption. One important element of the GRAT that is certainly very critical is the notion that you must outlive the annuity payments in order for the strategy to be successful. So if it's a 5-year term and you pass away in year 4, everything that's in the GRAT is basically clawed back into the estate. So we've historically been very conservative with how we've approached the design of these, and really not gone beyond a 9 or 10-year period during which the annuities would be paid, to minimize that mortality risk. How this will be impacted by what the House proposed is it'll basically eliminate the notion that you'll be able to have a zero gift, because if a GRAT is created after President Biden signs this into law, if it ultimately is adopted, the issue then becomes, once the annuity period ends and it converts from a grantor trust to a non-grantor trust, that would be considered a taxable event in the IRS's eyes. And therefore, you'd be making a gift of whatever the value of the trust is at that point. So for those of you who have used most or all of your lifetime gift exemption, it would effectively be triggering a gift tax of 40% on whatever passes to your children. So the strategy is really at risk based on the House budget bill. And similarly, this will impact qualified personal residence trusts. They have a comparable design to grantor retained annuity trusts, but they're specially geared toward residences. And so you retain the ability, as many of you know, to continue to live in your home for a period of years. And under the new proposed tax law, once that period of years ends, you're effectively making a gift of the value of the residence at that time. If the grantor trust, if contributions to the grantor trust in the future are considered to be included in the estate. So this strategy, which is also very popular, also effectively goes away.
So this strategy, Ben, is one of the greatest gifts we have, because it's just such an easy structure to put in place, especially if you have liquid assets. You make the contribution into the trust. The trust effectively is set up as a loan. In the end, the growth goes to your loved ones in a new trust that is set up at the end of the term, and that the payment is made back, as you said. Some neat strategies we've done, Ben, is set up the shark fin, which allows smaller payments to be made earlier, allowing more compounding in the trust, and then larger payments at the end, just to clean it up and make the final payments back. interest rates being low. It's just a beautiful way for people who've used up all their exemptions and may not be able to buy additional assets from their family and have a large taxable portfolio to move these assets. Sometimes, Ben, you and I have seen somebody that has restricted stock that they believe is going to be monetized, or the company is going to be sold and be freed up as well. Same thing. And so they'll put it in with some cash, and then they'll use the GRAT to make small payments earlier on. And then when the sale takes place and the stock is freed up, or any other private equity opportunity that they may have, then they can finish off the payments, but the remainder then is going free of tax. It's just a brilliant strategy. Of course, we know that mortality risk is the big one. So we want to have the GRAT as absolutely long as possible, Ben, but because we get growth. But if we die before that term takes place, then we're out of luck. So the short-term GRATs, 2 years and then renewing, 2 years and then renewing, allows us always to hurdle past mortality risk, and it's a beautiful strategy. And so requiring a 10-year minimum will put GRATs out of business for many. But the real nail in the coffin, as the expression goes, is that they're going to impute that you got growth and you got it to your children. And so that's hard for some people because they may not. And during the worst of the recession in 2008 and 9, we had GRATs that, quote, failed because there wasn't enough growth. The exciting piece was those folks immediately rolled over and did second GRATs. And boy, Ben, how prescient they look, because they then put this small amount in the depreciated market, and then explosion took place over the next 3 or 4 years. And by 2011, Ben, we were watching twice as much money pass to loved ones without tax as inside of it. So what we've recommended now during this period of time is to hedge your bets and to do multiple GRATs. Do a short-term GRAT so that you can outlive the term and feel like you have minimal risk of mortality risk, 2 to 3 years. Do a midterm GRAT at, call it 3 to 5 years, so that you're pushing out mortality, but still highly likely that you'll live through that period of time. And then do a long-term GRAT. Do a GRAT 8, 9, 10 years long. And yes, there's mortality risk that's greater, and it bumps up exactly where the Biden administration wants you to start. But you're doing it without imputing any gift on it, because that's what the new law would require. And that would say that you're using a fraction of that total gift in as imputing a gift without ever knowing that it's going to work out. So you have low interest rate environment now, you have no gift tax, and yes, it's a long GRAT. That 10-year GRAT is a longer GRAT, but it's blended with 2 other more conservative approaches. And if the law changes and GRATs are outlawed, you've got 3 glorious strategies, short, mid, and long term, to get a significant amount of growth out of your estate while modulating mortality risk and no tax payment. That is why that strategy should be done now, while we know it's still available. Thank you, Ben.
Thank you, John. Appreciate that. The last strategy and technique that's at risk is the notion of valuation discounts. We know this has long been on the radar of the IRS, but again, this represents a real effort that we'll talk about momentarily to, effectively take away the benefits that you've previously enjoyed here. A brief review: valuation discounts have been popular when you're transferring a non-controlling, illiquid interest in a private company. It could be an operating business, it could be a company that holds real estate investments, and of course, it can really hold any type of family assets, whether they're alternative investments, marketable securities, and a blend of all of the above. And so when we have designed these types of vehicles, knowing that it's intentionally structured so that most of the interest is either a limited partnership interest or a non-voting interest, because of the fact that those equity rights in each entity do not have any ability to participate in the management of the company, do not have the ability to force the dissolution or withdraw from the company. There are significant restrictions on transferability. Again, it's not marketable like trading Google or Apple stock. Because of all these limits on how you can monetize and liquidate it, you have been able to shrink the value for gifting purposes. And that, again, has been a long accepted concept from the IRS's standpoint. And just as an example, if you have a $15 million family holding company that owns a diverse array of different classes of investments, and 99% of that is concentrated in limited partnership units, again, that don't have the ability to make decisions about the operations of the company, and all of those other prohibitions are put into it, and you gift that 99% interest, you're not really making a gift of 15 million, you're making a gift of closer to 11 million. And that works nicely because that's the current exemption. And because you're able to essentially get an additional 4 million out of your estate that you wouldn't have been able to do without a gift tax if this notion of valuation discounts weren't possible. And so that $4 million difference in this example represents the immediate tax savings because that is additional wealth that's out of the estate. But when you think about how that $4 million then compounds and grows over the remainder of your lifetimes, that's where the real meaningful tax impact can be for your children and grandchildren and other loved ones. And so if we look to what is being proposed in the current budget, there's basically a red line elimination of any opportunity to take a valuation discount when we have a gift between family members. So that $15 million business, doesn't matter if it's in limited partnership units or their non-voting interests or what have you, that will no longer be possible to shrink the value of the gift. And the other concern here is that even if this element of the legislation isn't ultimately enacted, we know that, again, this has long been a focal point for those who want to make it a bit more challenging to transfer wealth effectively and efficiently. And so during the Obama administration, he asked the Treasury Department to interpret its rules around gifts of closely held businesses differently. And the Treasury did issue proposed regulations that would do the same thing that this current budget is seeking to do. And so we know that this is one of the pieces that John mentioned earlier, that even if it does not come about, there may be other ways that the administration would have to end this technique.
Well said, Ben. Not much more needs to be said on this piece. I think you hit it on the head. There may even be constitutional challenges as to this piece. But what we do know is it will be much better to get on the last, and we used this in 2013, Ben, to get on the last ferry boat leaving Nantucket than wait to call around for a helicopter or the following spring as fall comes upon them. So this is the time to be addressing these things now. And you've demonstrated really clearly where the consequences are. Thank you, Ben.
I appreciate that. There are reasons why, outside of these possible tax law changes, that we would likely be having these conversations with you anyway. Yes, this legislation presents some urgency because of a time sensitivity, but broader market conditions may favor wealth transfers for particular investments right now as well. And the first reason is we've seen for many of you, as a result of COVID, your operating family businesses, certain other types of private investments and real estate investments, especially in New York City, have declined in value. And as a result, we find that this would be a really appealing time while we're at a relative low point to consider transferring those assets. We know that the values will recover. And we also know that there, over a long horizon, there's meaningful opportunities for continued growth thereafter. And we find that to be appealing from a wealth transfer perspective, because again, it's really all about appreciation and value. For every $1 million that an asset grows after the gift is made, you're saving effectively at least 400, but in some states that do have an estate tax like New York and Connecticut, $500,000 in future estate tax. So when we're gifting assets that are undervalued, it does give us, confidence that we're, benefiting as much as possible from the efficient transfer at that low point. The other reason why the general environment right now makes for wealth transfer opportunities is because interest rates continue to remain low, and I think they dropped again for October as compared to September. And it factors into the GRAT strategy, which we talked about. If interest rates are lower, then GRATs are more effective because that means there's less of an annuity that has to be paid back to you and more can remain invested inside the trust. And the more that is in the trust, the greater potential for continued growth and value outside of the estate, as we've been sort of hammering home here today. And again, the installment sale, which we know is at risk, also benefits from low interest rates. When you sell an investment property, business interest, or other asset to a trust and you take a note back, that note, of course, will have an interest rate. If the interest rate is lower, there's less that the trust is required to pay back to you. So similar to a GRAT, it allows more to remain in the trust outside of the estate. So again, independent of what is being proposed in Congress, just the general environment right now makes it a really interesting time to be considering significant wealth transfers. And to sort of discuss how we've been positioning this with all of you over the past several months, and even before, ever since it looked like the Trump administration was in trouble and Republicans were going to lose control of both houses of Congress, we've had these types of discussions with many of you, and it continues, no doubt, to be a period of uncertainty as to how all of this will really play out. We don't know what's going to be included in the budget proposal at the end of the day, and if this is all just a fire drill or not, if there's more significant implications to your ability to take advantage of these approaches. But from our standpoint, if we look at the bigger picture, the vast majority of you already have estate tax exposure right now, during a period where we know the laws are as generous as they've really been since the estate tax was first instituted. And that problem's only going to worsen as your estate appreciates in value. And so the general thought here is, knowing that you've been considering likely leveraging most or all of your remaining exemption or taking advantage of these various tools that we've gone through, we want to be positioned to take advantage of them while we do have certainty, which is basically right now and before any possible legislation is enacted, that they remain available. And yes, if nothing comes about in Congress, if there's no deal on the Democrat side that gets brokered on, passing a big spending effort, this was more an excuse to do something that you've always really had to do, for the past number of years, and that's to get the growth out of the estate. And that's, again, we've been beating a dead horse here, but that's really what we want to emphasize, is the problem only gets more difficult as your estate continues to grow.
Well done, Ben. Thank you so very much. Obviously the key is to take action, but part two here is to, discuss these strategies specifically with you folks and answer questions that are directly pointed to your facts and circumstances. We are here to do that. Reach out to us. Our time is tight, so with it, we'll ask that as you reach us, to be as prepared and thoughtful as you can about your issues, so that we can spend the majority of the time being problem solving and solution oriented for you. Again, this is an exceptional time, and when there are fractures in the investment markets or fractures in other areas now in tax legislation, it creates opportunities. And so you count on us to do that. And Ben put this series of slides together with his team and the private client group so that we could provide this and expand this to everyone. And we could not be more excited that we're getting this message out, and we look forward to hearing from you. So wishing you all the very best on this beginning of the chill and the fall days coming forward, and we are excited to hear from you. From my side, Ben, thank you so much.